Hello everyone, welcome to Commerce Gyan. So this is our first video and we are going to start from the basics of accounting. Under basics of accounting, you are going to learn what is accounting, the importance, the principles, the conventions of accounting, and at the same time, we are going to go step by step right from understanding journal, ledger, trial balance, and making the balance sheet. So this will be a set of videos where I'm going to share in detail how you can the various aspects of accounting, and by the end of the videos and completion of this entire set of videos you will be able to prepare the final accounts, that is the balance sheet, the trading and profit and loss account, on your own. And at the same time, your foundation of accounting will be very strong, because you will be able to understand all the principles of accounting and principles and the basic rules of accounting, which are very essential for commerce. So here we are covering basics of accounting, and in this part 1, we are going to learn a number of things. And what are these things that we are learning? First of all, we will understand what is accounting. Second is we are going to see to it as to why we need accounting in this, you can say, world today. What is the importance of accounting? Third, we are going to see the definition of accounting. That means there could be, you can say, a rataya definition which is required for textbook study, and this we are going to also cover. Plus, we will understand the meaning of that definition. And the last part that we are going to see in this particular video will be basic important terms that are used in accounting. These terms are very essential because they form a base of understanding entire accounting. Last part is specifically very essential. So these 4 things are the stuff that we're going to cover up in this particular session. So let's move to the first part. Now, see, if we take into consideration today's world, before we go to today's world, if you remember, in the olden days, good old days, there was like barter exchange. What was this barter exchange? Where we used to see that a farmer has cultivated rice in his fields, and this rice is extra. So what he does, the farmer next door is cultivating wheat. He needs wheat, and the other side, the other farmer is requiring rice. So they exchange this 1 kg of rice maybe for 2 kg of wheat, or whatever the ratio was finalized. So that was what was barter exchange. Even in households, now you see that in the olden days, the neighborhood used to say, okay, aaj chai patti khatam ho gayi, so give me a little bit, 2 spoons today of tea powder, and you borrow sugar from your neighborhood, and so on. So that was what was the barter exchange system. I mean, in those days, people used to keep the accounts in their mind. अरे उसने मुझसे 2 चम्मच चीनी लेके गया था. So now next time I will also take something in return. So that was what was basis there. Basically, we used to see accounting. Accounting means keeping records. First primary thing in accounting, what we do is keeping records. Even if it was barter exchange, they used to keep their records, but those records were in their mind. But today, the things have changed. In modern world, we see industries have been formed, complex machineries are installed, and you see the scale of operations has like tremendously increased. So this increase in the scale of operations, transactions are happening in huge numbers. And if we see these transactions, we cannot like just memorize and keep in our mind and say, okay, I will remember everything. Not possible, right? For human mind, it will be impossible. By the end of the day, you forget what you had for breakfast in the morning, or how much you spent on a particular thing like petrol in the morning. It's not so easy to remember a year's transactions, or maybe the last 10 years transactions in your mind. So you need to keep them recorded somewhere. And that is where accounting plays a role. Accounts means basically keeping of those records in a very systematic manner, in a way that the larger group of people in the society will understand. So that's why we see that accounts has become essential, important in the current date. Now we proceed to the next stuff. The next stuff is where we are going to talk about the meaning of accounting. As I told you, you need the definition, right? Even if we know the meaning of accounting. It is also sometimes essential to know the definitions if you have to write this stuff for a particular examination, or you have to keep it in your mind for a particular systematic communication. So that is the reason we need a definition. So the definition of accounting is what? Accounting is the art of recording, classifying, and summarizing. Okay, record, classify, summarize. We will see this as we proceed to the further stuff of journal, ledger, trial balance, and balance sheet, and all those things. So right now, you just remember, like suppose if we take a simple example, I had to buy something in the morning. Let's say I got out of my home and I brought milk and bread for breakfast, let's say. So bread and milk that I purchased in the morning, this particular part of my day was a transaction, right? I had paid some money and I bought some goods for my consumption. So what I have to do is I have to understand that these goods were for consumption, record them in a particular book in a particular format, classify it, whether that expenditure was a short-term expense, long-term expense, or whatever, and summarize in the end. Suppose at the month end, you ask me how much was your milk cost, or how much did you spend on milk in this month, or how much did you spend on bread this month. So what I'll do, I will sit with the book and I'll take the total and tell you, okay, this month's expenditure was 3,000 rupees on milk and maybe 1,500 on bread, whatever the case is. So this is what I'm doing, is basically recording, classifying, summarizing, and in a significant manner and in terms of money. So significant manner means in a specified typical manner, I have to write it down, whatever the formats has been given, and in terms of money. So that transaction is significant, meaning it has some amount, some value, and this value is basically convertible in terms of money. Suppose you're going traveling on the road and there is a small accident which happens and you have a fight with the other vehicle person. You just have a fight and you hit that person. That hitting has no monetary value as such. But if you hit that person, or if you hit that person's vehicle in a way and it causes damage and you have to pay for the damage, right? That will have consequences in terms of money. So you don't record the slap in your books of accounts, but you will definitely record the loss which is caused to your vehicle, and the damage that you caused to somebody else, for which you had to compensate. So that is because it is convertible in terms of money. Okay. Then comes the next part, that if you're seeing it should be convertible in terms of money, transactions and events which are in part at least of a financial character, and then you will be interpreting the results. Okay, so basically what you're doing, you're recording, classifying, summarizing all the transactions that are convertible in terms of money, or at least in part they are of a financial character, and then you are going to interpret the results thereof. Interpret the results will be a secondary part of accounting. The primary part of accounting is this three things: recording, classifying, summarizing. So this is what we mean by account. This is the definition, the conventional definition of accounting. And based on this, now I want to proceed to the next part that we have to learn, which is the basic terms in the definition. Okay. So this is what we have as a list. So what we have, we record, we classify, we summarize. And these transactions should be dealing with financial transactions. That is what I just told you. Analyze, interpret them, and then communicate. So this is the whole set that happens. This is the entire thing which happens if we speak of when we are talking about accounting. Hope that is clear. Basic terms in accounting. Very important, very essential to your understanding. These are the terms that we are going to learn in this particular video today. Each and every term will be frequently used as you deal with accounts, finance, and entire commerce. So if you go through these list of terms, you will see they are very commonly used. But do you really know their difference? Do you really know what these terms mean? So let's take the first term now. If you see the first term, transaction. Transaction is something which happens in our everyday life. If you see, a transaction is defined as occurrence of an event that must be recorded. So for accounting, what does it mean? It is an event which is something which is recordable, which should be recorded. And when do we record in accounts? When it is convertible in terms of money. Take an example again. Suppose, let's say, a company has a very important officer, let's say their CEO. The CEO of that company or even a director of that company resigns. Okay, resignation of a director has no transactional meaning in accounts, right? A direct thing is not happening. You don't record in accounts that, okay, this so and so person has resigned. But if you have to pay a compensation to that particular officer for resignation, that means maybe some allowances and some pending amounts have to be paid, then yes, this amount has to be treated as a transaction. So all the events or the things happening in our life are not treated as transactions in accounting. They definitely are important. So resignation of a CEO or a director is definitely an important event for the company. But unless and until it has some monetary, you can say monetary benefits or monetary loss, unless and until it has some monetary impacts, this particular amount will not be recorded. Okay. Now let's take the examples. If you see the examples in this particular slide, you can basically understand what are the transactions like. So buying of various electronic goods for sale. So you buy a mobile phone, let's say, and this mobile phone becomes a transaction for you, buying of it. Selling of articles to customers. So a shopkeeper is selling goods to the customers. Yes, this is a transaction. Purchase of a shop where the products would be, purchase of a shop, like I buy a property. So that is a transaction. Paying various expenses, day-to-day expenditures, electricity bill, telephone bills and stuff. So all this is also a transaction for your business. Okay. So I hope the meaning of a transaction is clear, because everywhere we are going to face with different events and different things which will be formed in as transactions for you. So that is the first term. Hope that's clear. Now we go to the next term. Next term is recording. As we have seen, recording of is basically what? Documentation. Now, if you are a very particular person, you will even keep your day-to-day expenses and amounts that you have in hand in your diary. You will list out, okay, I have a pocket money, let's say, or I have an amount which I earned of 50,000 rupees in the beginning of this month. Out of this 50,000, I spend so and so amount, some part on groceries, some part on stationery, some part on maybe my payment of my bills, the rent, everything. And I just list out. So what are you doing? You're basically keeping records. Very important habit is record keeping. Okay, even in many other sectors, like even for research and other things, recording is very important. Documentation and documentary evidences are essential and important. Even our court of law requires the evidences to be kept. So recording is a very essential term that is used in accounting, and accounts is basically connected with keeping of various documentary evidences to support the transactions, right? So recording is keeping of the documentation that is supportive to the transaction. So suppose I buy an ice cream, let's say in the for consumption. Suppose I buy an ice cream, and when I buy ice cream, what do I do? I pay the amount and I take a bill. Tomorrow, if my friend says that, okay, show me a proof that you had an ice cream. So how will you prove to her? What you'll do is you will take the bill and you'll show it to her. See, this is my bill and this is where you can have a proof that, yes, I had an ice cream yesterday. Okay. This is what is the record keeping. So record keeping not just relates to keeping of the written records, but also keeping the documentary evidences to support these recorded documents. Moving on, we are now here to understand the term income. Now, if you just read through the definition, standard definition given of income, what it states, income is something that is earned in monetary terms from the business or commercial activity on regular basis. It is the amount before deducting any expenses associated with that activity. Now, take examples. Give me examples if you have to speak about incomes. What are the various sources that you can get in your mind when I talk about income? Some may say salary, some may say that, okay, I sold goods and I earned some money, so that becomes my income. Now, what is very essential here in terms is basically regular basis. If you see here, this particular stuff, regular term is very important, regular basis. So if you have some amount which you earn once in a while, it will not be treated as your income. Okay. It will be treated as something else. It's called as what we say, we will see later, which is called as gains. But in the case of income, income is a regular activity and it is earned in monetary terms, right, by your business. So if simple examples, if we take, it's a stationery shop and the person is selling goods. So goods sold will become the income. If you take examples of banks, what are banks doing? Bank have the business of taking funds from people and giving them out on loans. So for them, what is their income? Their income will be the interest that they earn against the loans that they give, because that is the amount of income. Correct? Take another thing. Let's suppose I buy a lottery ticket and I win that lottery. Will you say that this is my income? Well, not. It is actually, yes, it will be an amount earned, but it is not regular. It's not my source of earning or living. So that doesn't become my income. That will be something else which we call as the gains. Okay. Another important thing in the head of income is that basically we need to understand one last part of this line saying that the amount is before deducting of expense. So if I say that you made a sales amount of 1,000 rupees and against that you had to purchase the same commodity for 700. So what is the differential amount? 300. That is not your income. Your income is the 1,000 rupees of sales that you made. Fine. So it is before deducting any of the expenditures against that particular income, against that particular amount received. That is what we mean by income. So hope this term is clear. Income is on regular basis, firstly. Second important thing is that it is before deduction of any of the expenditures. Fine. Next important term that we are going to learn is expense. Now you have heard of expenditure every now and then, and in fact you also would be a person who is spending, who is giving away of money in your day-to-day life, and this is what is basically your expense. Expense is something where you're spending money, right? Now here in this definition, if you see, they are saying expenses are those costs which are incurred by the business in the normal course of activity, or sometimes there may be some costs which are abnormal yet related to business. Now, there are two things used here, cost and expense. To understand the difference, I'm going to tell you an example. Suppose you go into a mall and you just see the lovely stuff which is put and displayed, and you just check out what are the price tags of that particular commodity. Let's say it's a clothing brand, and you just check the label of it and you see, okay, price money is that you're supposed to pay is 3,000. So 3,000 is the cost. Have you paid it yet? No. Till you make the payment for that particular amount, it remains as a cost to you. So if I want to buy a laptop which is of 50,000 worth, 50,000 would be my cost. But when I pay that amount, that becomes my expense. Expense is something which is the money spent. Got it? So till you spend it, it is a cost. And once you spend it, it becomes expense. That is the difference. So expenditure is something which is on regular basis. It could be electricity payments, salaries which I pay for business, like to the employees. Then there would be purchases which I'm making for selling of the goods. paying off maybe some consultancy charges for legal charges, whatever the case may be. So all these would be the expenses that the business is incurring in the day-to-day activity. So income, expense, and now we move to the third term, which is profit. So it relates to two things, income and expense, right? So profit is something which is the income over and above the amount of expense. So like I told you, if you sell goods worth 1000 and you buy that same product at 700, income is 1000, expense is 700, and 300 becomes your profit. Okay. So profit is that part of income which you earn over and above your expense. So if my expense was 700, if my income was 1000, then what is my income over and above this 700 rupees? It is 300. So that 300 becomes my profit. Now profit, as it's very essential to understand, is a regular amount which is earned. That means it could also be said in terms like amounts earned from business activities. So if you are running a business of consultancies, then consultancy receipts minus all expenses related to consultancy will become your profit. But suppose that same consultancy business owns an office and it sells off the office. Is that the income or is the amount earned over and above the amount spent as the profit? No, it is not a regular activity of that business, and so it is not considered to be the profit, correct? So income is the on regular basis, expenditures are on the regular basis, and in this case profit is also something which is on regular basis for which the business is started. Next we move to the term which is loss. Loss is obviously something which is expenditures more than the income. So if my incomes are something which I'm earning as, let's say, 700, and I have to spend money of 1000, then what is left with me is a loss of 300. So I have to recover this 300 from somewhere to compensate because I have paid more than what I earned. So I earned 700, I paid 1000, and so the loss, the differential amount, that is the expenditures which were more than my income, were how much? 300. Got it? So when the expenses incurred in the business exceed the incomes generated, then it is said to be a loss. Got it? Now, generally, this is in the course of business activity. So if your regular business activity is that of selling electronic items, then electronic items, the sale and purchase will be your regular income and expense, right? Against this, if you're having any other expenditures, those will also be reduced. And if you're left in hand with some extra income, then that becomes your profit. If you're left with some extra expenses over and above the amounts earned, then that becomes your loss. Got it? Next, the next important term which we are going to take into consideration is the word capital. Every one of you, I think, must have come across this term some or the other time in your life, capital. Capital is something which is the investment that you make in any business. This can either be owned capital or it can be borrowed capital. So if we are saying it is like I have to start my own business, I invest the savings from my own pocket, then this amount of savings which I'm putting into the business becomes my own capital, the owner's funds. Correct? If I'm speaking about the amount I borrow, my friend is also interested in the business, but they don't want to be a part of the business. They say, okay, I will give you some money. You borrow this from me, and once your business starts running, you return it back. So what is this for me? It becomes a borrowed fund. Friend is not the owner of the business. Another example, if I talk about a bank loan, I take a part amount as my own savings and part amount I take from the bank. Then this bank loan will become the borrowed capital, and part amount which I invested from my pocket will be my own fund. Now remember one thing, when I use the word capital, without saying whether it's own or borrowed, it always means it is own funds. owner's funds. Capital becomes the owner's funds. Unless and until I say it is borrowed capital, don't assume anything else, right? So if I use the word capital, it will mean what? Owner's fund. Now, whenever you earn a profit, what happens to this owner fund? Owner fund becomes more because you earned a profit. What happens if you earn a loss? Owner's fund will go down. Next term, important term, asset. Now we often say like good people are an asset to us and bad people are a liability in our life, right? So often you may say, even if you're speaking about different. So if we say we talk about an asset, asset is like a property. Okay, it's something which the business owns. And these properties are basically long-term ones. So if I say I buy land, building, machineries, furniture, fixtures, these are not just bought for 1 year's duration, right? When a business is set up, these machineries are going to give it, you can say it will be running in the business for a long duration. Another important stuff that the assets do is assets give you income. Assets generate income. So if I buy a machine for making of something, let's say I buy a food processing unit which is going to make jams. So what is basically happening here? The amount I'm putting into the machine, this will be taken into consideration as an asset. And when this asset is basically you can say used in the business, this machinery is used in the business to make the jam and the jellies and the production of it, and sales happen. What is it going to generate is income. So assets very clearly are income generating properties. So property which has some value, and at the same time this property is generating revenue, generating income for me, right? This is what you really mean by assets. Now, mainly assets, when I say assets, are generally long-term assets. But there are also certain assets which are short-term, which are classified as current assets. So if you see your long-term assets will be called as the fixed assets. If you see the assets further classified into those two parts, which you can see in the slide, you will see one is fixed assets and second one is current assets. So fixed assets are more than 1 year if they're going to give you a benefit and they're going to be with you in your business. This becomes a fixed assets. Example is land, building, furniture, fixture, machinery. If I say current assets, what is a current asset? Current asset is nothing but the asset which is giving me a benefit. It is a property, but it is giving me a benefit only for a short duration, like stock, inventory. This product which I've made or produced in my organization, this is going to be sold off, and this sales is going to take place and the rotation will take place within 1 year. So that is why the classification is nothing but current assets. Okay, so this is what we mean by assets. Next, we are talking about is liability. Suppose some person is a big trouble to you. What do you say? You are such a liability to me, such a headache to me, right? So liability is something which I have to pay for. I don't get anything, but I'm going to pay for. Liabilities, so in this way, we can say for a business also, liabilities are the claims that the business has against its assets. I take a loan. What is this loan? Loan is a liability. I have to pay electricity bills. I have not paid it. It's a payable to my business. The payable becomes the liability. So liabilities are the business has to pay off some amounts to people or to organizations, right? So if you look at the definition, liabilities are claims that business has against its assets. Thus, it can be said that when a business owes some amount to other people or organizations, it becomes the liability to the business. Fine. So again, as we have assets which are long-term and short-term, we have liabilities also, which are long-term liabilities and short-term liabilities. So long-term liabilities, as we know for a business, long-term means more than 1 year. And if it is short-term liability, short-term means less than 1 year or up to 1 year. So long-term liabilities are a part of business and short-term liabilities are also a part of business. They are long-term is classified as long term, but if it is short term, it is called as current liability. Just like we have current assets, we have here current liability. Got it? So hope this definition of liabilities is clear to you. And then last two things are left for us, and last two things are nothing but the income statement and the balance sheet. Okay, income statement, when I say, see, normally when you start a business, why do you start a business, or why a business is being done, or why normally when you're doing a business, what is the main motive? The main motive is earning profits and sustaining the business in the long run. This is the motive. Earning profits. How do you know that you've earned profits or you incurred a loss? Well, that is basically from the income statement. So if I have incomes and against that there are some expenses, if we match the two, then only I'm going to understand whether I have earned some profit or whether there is a loss in the business. So that is where this particular part of income statement comes into picture, and it is giving you a clear idea of whether your business made a profit or it was into losses. Okay. So if at all your incomes exceed the amount of expenditures, it will be a profit. If your incomes are less than your expenses, what happens? You incur a loss, right? So that is where we are talking about. So this generally income statement is given in the format of profit and loss account, trading profit and loss account, or manufacturing, trading and profit and loss account. We will see that later in the upcoming videos. Now, one essential thing to remember here is that this particular income statement is generally prepared on yearly basis. Some people may also prepare it on monthly, quarterly, or half yearly basis, but generally it is on yearly basis. The last thing that we are going to understand today is the balance sheet. Okay, as we have income statement which is meant for incomes and expenses, same way we have the balance sheet which is meant for matching of assets and liabilities. I need to know, right, how much is my own net worth. If I have, let's take a simple example, like I have a house which is worth 5 crore, and against that 5 crore of house, I have 3 crore of loan. What is the net impact of this? What will I get in hand if I sell off the house and I pay off the loan? What will be left in hand? 5 crore of house, 3 crores of loan. So net amount of 2 crores, it is what will be balance in my hand. If I nullify everything, I sell the house and I give away the liability of the loan. So what is net amount that is left in hand for me is 2 crore. That is the balance sheet is something which is telling me the worth of that particular business if the assets and the liabilities are matched. This is the importance of the balance sheet. Just like income statement gives me the understanding of profit or loss, balance sheet gives me the understanding of assets and liabilities, right? Usually it gives me the idea at the year end. So balance sheet is also generally prepared by a business at the year end. However, balance sheet, some cases like in the case of a bank, the balance sheets or the profit and loss account and such stuff may be prepared on daily, weekly, monthly, quarterly, half yearly basis also, right? Hope that is clear. So income statement and balance sheet. So this is what we have learned in part 1 of basics of accounting till you can say the various terminologies of accounts. In the next part 2 of the video of accounting, we are going to learn about the important aspects of accounts, like where exactly accounts is used, who are the people who use accounts, where do accounting evidences work in different areas of our life. And at the same time, we are going to see the principles and the conventions of accounting, which form the basis of making journal entries, of understanding various, you can say, aspects of accounting. So journal entries, ledger, trial balance, and balance sheet, everything is based upon these principles and conventions of accounting. If you don't know that, your foundation of accounting will not be strong. So see you in the next video. of part 2 of Basics of Accounting. Thank you.